Is McDonald's a high-quality company trading at fair value, or is it maybe an overpriced, overvalued stock that we should avoid at all costs? This is what I'm going to analyze in this video. I'm going to analyze McDonald's and figure out the fair value on it, a buy price that would be an amazing buying opportunity, give you my overall opinion. Why is McDonald's down over 10% year to date, with the S&P being up, the Dow being up, the Nasdaq being up, many different stocks being up a lot, yet McDonald's is down 10%. There has to be something going on, and this is what I'm going to try to explain in this video. Now, for the last earnings of McDonald's, they weren't the best at all. They did beat on earnings per share, $2.95 versus $2.82, not bad at all, but they did miss on revenues, and they also missed on same-store sales growth, and the company itself blamed it on some boycotts related to what's happening between Israel and other counterparties, and this is what happened, and McDonald's took a stance with one group against the other group, and then it's going to upset some people over here, and it's going to make other people happy, and this is normally a bad move from companies to take sides on certain things, because you're going to upset the other side, and then it's not the best thing to do for shareholders in general. And this is what happened, and you have some boycotts over there in the Middle East and from many people from the Middle East, and it's over 10% of their stores, so a lot of people over there are trying not to go to McDonald's, and same-store sales growth fell internationally, and this is one of the reasons why McDonald's has been suffering somewhat in the last quarter. Same-store sales was still 9% for the year, but it did decline to 3.4% in the last quarter of 2023, and it should maybe start to improve in 2024. But as I said, this is not the only reason, and maybe this is something that you don't know, that yes, McDonald's stock has been up so much over the last few years, but McDonald's earnings themselves, or revenues specifically, they've been declining. McDonald's is a declining company initially. It's been declining since 2013. Every single year, revenues have been declining. And after 2020, we had the stimulus, a lot of things happened. It took a massive jump in 2021, and this has sustained itself into 2023 to over $25 billion of revenues. But if you look at it, McDonald's in 2023 is still making the same revenues they made in 2015. So McDonald's is not the fastest growing company ever in terms of revenues. But if you ignore revenues and you look at earnings per share, you could look at earnings per share. They're up a lot. In 2015, they were $4.80. Now they're $11.56. Now this is due to many different reasons. It's also due to some margin expansions, companies increasing the franchising stores and selling their own stores and having more franchising revenues and royalty revenues. This is pretty amazing. But there's a much larger reason I'm going to explain. And this is something you have to know if you own McDonald's stock, and this is mainly the massive debt that McDonald's has. It went from $11.3 billion to $32.5 billion, and this is largely due to buybacks. This is where the earnings per share growth came in. Yes, of course, it was also due to some margin expansion and profitability expansion in general, but earnings, or mainly shares outstanding, have been down significantly over the last few years. And if you look at, I could show you a picture over the last 2 years, and you could look at the free cash flow, you could look at the dividend per share or the dividend paid, and you could also look at the total buybacks. They barely even match the free cash flows that they have, and they still have a lot of debt obligations. So McDonald's have been taking on debt to buy back stock, to artificially inflate earnings per share, and buying back stock at much higher multiples, 25 and 26 times earnings, which is higher than the historical average. Now, I'm not saying this model doesn't work. I own a stock called AutoZone, and AutoZone does the same exact same thing. It even does it even more than McDonald's does it. AutoZone does the same thing. O'Reilly's does the same thing. Lowe's and Home Depot do the same thing. So I'm not saying this model doesn't work, but you have to know this if you're buying McDonald's, is that revenues have been flat, but earnings per share has been increasing. Some profitability expansion, of course, but it's largely due to them taking on debt to do buybacks. And they can keep going on forever, pretty much. Maybe not forever, but for a very long time. And this is something that you have to pay attention to. Now, as I said, a lot of the earnings per share expansion was due to profitability. They expanded the franchising business model, which has much higher margins and somewhat lower revenues in general. In 2013, they were 80% in terms of franchises. Now 95% of the revenue is franchise, high margin revenues, which is pretty amazing stuff. Now they are trying to aggressively grow into 2027 to over 50,000 restaurants by 2027. If they can achieve it, This is going to cause massive revenue expansion, in my personal opinion. We look at net income margins. As I said, net income margins has also expanded. It went from 18.5% to 34.2%, largely due to them moving to more and more of a franchised revenue business model. Pretty amazing stuff. Now, McDonald's does have a decent dividend. It's only 2.3%. It's not the largest dividend ever, but they do aggressively increase the dividend. And they increased it from 24 cents per share in 2002 to $6.76 per share going into 2024. So they do rapidly increase the dividend, and this is why the dividend is not very large. It's not the highest yield ever, but it's more of a dividend growth company than a very high, dying company that's a dividend yielder. Now, for my projection for McDonald's, again, you can see in the model that it's not the best valued stock ever. And if you look at the analyst estimates, they have between 5 to 7% revenue growth over the next few years. Now, we have to keep in mind that McDonald's was a declining company in terms of revenues, but they were able to sustain it, and maybe they can continue sustaining it later on. I'm not sure. So this is why we have to use more conservative estimates. Maybe the last 3 years was just a massive bump, mainly to them raising prices on many of their Big Mac meals and many others. A lot of people complain. I'm not sure for how long they can keep doing that stuff. So we have to keep all of those things in mind. So I think 6% revenue growth is very fair for a large company like McDonald's. I kept the same net income margins, 34%. I think it's pretty amazing. PE ratio, for the PE ratio right now, it's trading at 21.5 times earnings. As you can see, it's closer to the lower end of the range, around 21 times. This is where it bottomed. This is what it was trading at in 2018 and what it was trading at around 2016. The lowest it has traded at over the last 10 years was pretty close to 18 times, 18.5 times. It would be an amazing buying opportunity if we ever get back over there, excluding COVID, of course. In COVID, it traded as low as, I think, 14 or 15 times earnings, which was pretty amazing. But now it's trading at 21.5 times earnings. Over the last 10 years, the mean was 23 times. So I'm just putting in that McDonald's is going to go back to the 23 times earnings, which I think is fair. I used a 3.5% shareholders yield, which is the 2% dividend, and 1.5% buyback yield for the company, which is what they did last year. 1.5%, could be a little bit more, but I used 1.5%, which the total is 3.5%. In total, if you buy McDonald's today, I would expect a 10.2% annual return over the next 5 years or so, which is not bad at all. If you're looking for 10.5, 11, 12% return, McDonald's could realistically give you this kind of return. Now, for me, I look for doubles every 5 years or 15% annual. And if I want to double my money on McDonald's over the next 5 years, I would have to buy the stock around $208 per share. And $208 per share, or 210, is around a 20% decline from here. And I have to be honest, McDonald's has already declined. It has declined, I think around 9 or 10%, pretty close to 10% or 11%, which is not a bad decline for McDonald's. And normally these stocks, they always get bought way before they reach fair value. So I'm not sure if McDonald's is going there, but I think McDonald's right now for conservative dividend investors could be a buy, expecting 11-12% annual return. Not bad at all for a dividend company. But for me, if I want to buy McDonald's, I would love to buy it around 210, 215, maybe maximum 220, 222. I would be buying it, dollar cost averaging down. I'm extremely interested in the company, very high moat, very high margins. But again, it's very hard to get them at the right price. And the right price for me is around 220 or below, closer to 208 to 210. And it was not financial advice, just my opinion on McDonald's stock. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.